Thursday the 16th, we're an hour away from the opening trade, and this is what you need to know. President Trump acknowledges America is in a long-term trade war with China. Treasury Secretary Scott Bessent warns Beijing of a coordinated response to its rare earth restrictions. Sebastian Lecornu looks set to survive not one but two no-confidence votes today. We will take you live to the National Assembly in Paris. And TSMC hits a fresh record high as AI spending remains robust. The key story, though, is that its margin easily beat estimates. Valerie.
Well, that is boosting shares in Asia. The MSCI Asia Pacific up 0.7%, really leading the equity market gains across the globe this morning. S&P Futures struggling for direction, but positively in the green. Euro Stoxx 50 Futures, however, in the red, down 0.3%. The countdown to the opening trade starts right now.
Are we in for a sustained trade war with China?
Well, you're in one now. Look, we have 100% tariff. If we didn't have tariffs, we would be exposed as being a nothing. We would have no defense.
We are in a long-term trade war. The United States is in a long-term trade war with China. I think we knew that, to be honest. I think probably all the signals have been there for a while. My question this morning, Lizzy, is who's winning?
The US and China?
Yeah.
Well, both sides blowing hot and cold at the moment, and that seems to be what's making the market so divided at the moment. Value pointed out the difference between European and US futures. Even within that MSCI Pacific Index, you've got divisions between Japan and China.
Yep.
And it comes back to this blowing hot and cold. You heard the president there blowing cold, saying that they're already in a trade war. But then you've got Bessent, the US Treasury Secretary, saying that you could have a longer pause than 3 months on high tariffs if China puts the brake on the export controls. Then he's saying the meeting is going ahead between Trump and Xi, but also saying there could be an international response if you don't get on board with this. I think you pointed out the Wall Street Journal saying that China knows that the guardrails on President Trump is the market, particularly the stock market. Bessent's denied that now. So when you're asking me who's got the upper hand, Bessent wouldn't say that, in fact, it's China.
Yeah, Bessent definitely had some strong words to say to the Wall Street Journal yesterday about that article, saying they are not watching markets. They are in for the long game and trying to make this trade war work for the American people. He also said that they don't want to decouple from China, and he doesn't believe that China wants to decouple either. But he was actually pressed on, okay, well, what kind of tools are you going to use in order to leverage these negotiations? He mentioned specifically things like aircraft engines, minerals, and just the general dependence of China on exports to the U.S.
I'm sure America could go down that road, but it would be damaging to America. And I think that's the factor you need to fold into this. There's plenty of aircraft manufacturers, engine manufacturers that make a lot of good margins off selling spare parts on jet engines at the moment. Would that be a benefit to those in the United States? But look at what there is clearly a weakness in the US setup, because every time Trump gets tough, the stock market blows up and he backs down. We've got a word for it. It's called taco. I came from the FT. There it is. It's out there. But also, clearly, they are super sensitive to this rare earth story because they know the impact it's going to have, which takes you to the AI story, which takes you to what is basically supporting the US economy right now. The US has key vulnerabilities. I'm not saying China doesn't have key vulnerabilities as well, but the US vulnerabilities look really obvious at the moment.
Well, at least when it comes to at least the risk to the equity market, because it's so dependent on these tech names, on this tech trade going on, where earths do play a big part into making chips. But yesterday's session, when it came to the broader equity market, was really all over the place. Every time I checked my Bloomberg, we were up, we were down. At one point, we were up as much as 1.2%, and then we were down nearly half of 1%. We did end in the green, but the market is really trying to make up that gap from Friday. We are still down 1% since that slide from Friday. But it's really been the equity market that's been the key volatility driver. The fixed income rally has somewhat paused. Yes, we have two-year yields hovering around year-to-date lows. There are some options trades going on, speculating that perhaps the Fed could do a jumbo 50 basis point rate cut towards the end of the year. And then given the absence of data, there were more traders, probably more than usual, parsing through what the Fed's base Beige Book told us yesterday. Really not a lot of clues that the Beige Book gave us. It was ambiguous. Very beige. Yes, very beige.
So normally the Beige Book comes out and really goes, like, who cares? Rearview mirror. It doesn't matter. Just ignore it. Now it's super important.
No, but it said some interesting things when it comes to at least the tariff pass-through. It is not a clear direction. Some businesses raising prices, some slashing them, other ones keeping constant. And then when it comes to the labor market side of the thing, labor market side of the Fed's mandate, there were hints that while the employment stayed stable, there is a weakening when it comes to demand for labor.
Yeah. It's not terrible, but it's not great, I think would seem to be, to the beige narrative, would seem to be the story that maybe came out of it. It's also worth noting that Bitcoin is still down versus what we saw at the back end of last week and over the weekend as well.
And
which
yet
is
gold keeps hitting new records.
That was
partly because of the ongoing trade tensions, partly because of those Fed cut bets, also because of the shutdown and Bessent coming back to him saying that could start costing $15 billion a day if this continues.
The dip is being tested at the moment. We haven't bought the dip yet fully. We bought some of it.
I mean, you have to say tech stocks have done fairly well during this volatility. We saw AMD rising 10% in the session yesterday. Strong earnings from ASML, strong earnings from TSMC. You also have Fed members weighing in on just how the AI trade will affect the U.S. economy. We heard from Fed's Waller. In his mind, there is no doubt that AI will boost productivity and lead to better GDP gains and better real income gains for the American people.
I thought that was my cue to talk about TSMC. Probably should have been. TSMC, good numbers this morning. Nice numbers.
Very strong.
Beaten expectations, looking pretty solid. Stocks, we're at a record high now again, fresh record high for TSMC this morning. So the AI trade is definitely on. And the takeaway to my mind actually is the margin number. So that they're actually managing to do all of this at a better margin. They're taking costs out of the business. They're managing to actually deliver upon that, that kind of improved profitability. So that's dropping down nicely through the balance sheet.
But it brings us back to the trade story, because the CEO's talked about how strong AI demand is, but again, he's pointed to the geopolitical risk. And if you look at the food supply chain, it goes rare earths, ASML, TSMC. And so TSMC very exposed to what's happening with the export controls.
So how do you treat these stocks? Do you treat them as tech stocks, kind of the way that we normally treated tech stocks, or do you increasingly treat them as geopolitical proxies?
Well, TSMC gets 70% of its revenue from U.S. companies. It is highly dependent on selling the chips it makes to Nvidia, to Intel, to AMD. But it does really beg the question whether they are too exposed to the geopolitical tensions going on this week that could, in some point, in Trump's term, really come to well, I don't want to use an explosive language, but come to a big point when it comes to Taiwan and their independence.
Absolutely. We're jumping a few steps ahead, but people are already definitely talking about that. I just want to tell you about Nestlé this morning. Big job reductions, new CEO coming in, clearing to a certain extent house in terms of the numbers that they're delivering this morning. So Nestlé, keep an eye on that at the get-go trade this morning. There was a lot of talk yesterday about the fact that the luxury sector was going to make a comeback. This morning, Pernod Ricard kind of pours a lot of cold water on that, particularly in the United States, where drinking is apparently not happening, which is a surprise. And then also you've had, I think there's a big Berenberg note out this morning, which is quite negative on the tech stock story as well. Anyway, the question everybody's still asking is basically, are we in a bubble? And we're going to try and get an answer to that question next. Ben Gutteridge, Invesco Market Insights strategist, is going to be joining us very shortly. Michael Widmer, Bank of America Head of Metals Research, is going to be joining us, as is Karen Ward, JP Morgan's Asset Management Chief Market Strategist. Matthias Burkhardt is the Ardian CEO of France and Head of Infrastructure. The giant French private equity firm this morning has confirmed a record $20 billion European infrastructure fund. And we're going to have a conversation with him later, and he's going to talk a lot about the fact that actually Europe is seen as the diversifier. Europe was deeply unsexy at the beginning of this year in some people's minds as a place to put money to work. Now, apparently, it's getting a little bit more exciting. We've also got a conversation coming up with BYD's Executive Vice President, Stella Lee. Look forward to that conversation out of South Africa at 8:45 UK time.
Let's take a look at the risk events on horizon for today at 1:30 p.m. time. At 1:30 p.m. UK time, we are going to get a shred of data when it comes to U.S. jobless claims. Remember, Fed Chair Powell drove our attention to the state-level jobless claims are released. He says that those are still a good data point when it comes to the U.S. labor market. At 2 p.m. London time, Fed's Waller will be sitting down with their own Tom Keene in Washington. About a lot of speakers coming out of the IMF IMF happening in D.C. this week. Later this evening at 5 p.m., we'll hear from ECB's Christine Lagarde. After market, we do have results in Europe from EssilorLuxottica. And then another thing to monitor over the course of the day is not one, but two no confidence votes facing the new French Prime Minister.
Yeah, we'll have live pictures of that, hopefully, within this programme. And, you know, we saw that French relief rally yesterday in the stock space. That's much more to do with LVMH's performance. But in the bond space, you do wonder whether that can hold. And it doesn't look like there's much danger for Lecornu in these votes of no confidence, given that he's supposedly got the support of the socialists because of the compromise on the pension reform, but always
apparently
ready
French
for
business
surprises.
is deeply ticked off this morning. The reason for it is basically you're getting rid of the pension story, you're watering that down, but you're going to keep the windfall taxes on us? Great. So basically, we are getting a double hit here. So French business not exactly pleased. So I'm really interested to hear the Ardian conversation, the Ardian take on that.
Well, when it comes to the timeline this morning, the debates do start around 8 a.m. Our reporting is suggesting that these votes could happen fairly quickly over the course of the morning now that he's garnered the support.
You want to get it done fast, don't you?
Yeah.
Let's get on with this, folks.
Anyone changes their mind.
think we've got this one nailed down. We'll make sure we get it done quickly.
I'm sure he's hoping there's nothing to see here. But here's what else you need to know this morning. President Trump says that India has promised to stop buying Russian oil, signalling a possible resolution to an issue at the centre of the rift between Washington and New Delhi. Trump said that Prime Minister Narendra Modi made the commitment to him during a conversation on Wednesday.
If India doesn't buy oil, it makes it much easier. And they're not going to buy. They assured me they will, within a short period of time, they will not be buying oil from Russia. And they'll go back to Russia after the war's over.
Elsewhere, Japan's ruling party leader Sanai Takaichi boosted her chances of becoming prime minister after agreeing on policy talks with the Japan Innovation Party. A partnership would give the LDP an additional 35 seats in the lower house, still seats short of a majority, but well ahead of any opposition bloc. And here in the UK, Chancellor Rachel Reeves has been warned that she'll need an extra £50 billion fiscal buffer for a better than even chance of avoiding future tax rises and spending cuts. According to the Institute for Fiscal Studies, Reeves may need to find as much as £22 billion at the budget next month just to restore the razor-thin margin that she had in March. Well, we know that every time there's been a fiscal event, she's had only £9.9 billion of margin. You've got all of these calls, not just the IFS, but Bloomberg Economics and Oxford Economics calling for a bigger buffer as well. It seems pretty politically impossible to get that through. But if she does more tax rises, you also have to wonder what's the impact on GDP. And we're seeing it this morning. As expected, GDP coming in at only 0.1% for the UK. That is partly because of the tax rises she's already done previously.
Do you not get... You say it's politically impossible. I don't know. The table seems to be being set for tax rises, income tax rises to come through. VAT would be really difficult because basically it would be inflationary.
Well, we're going to be speaking to Karen Ward later, right? And she's saying you've got to do spending cuts, not tax rises, because otherwise you keep her in the
So talking of politically impossible, that feels more politically impossible than raising taxes right now.
True. Starmer's so politically, personally weak right now to try and get more spending cuts, austerity basically past the left of the party. That's what I mean is impossible.
Well, it feels like a shame that the OBR likely snap these markets before the 20 basis point rally in gilts that we've had for this month, which would have maybe given her a bit more headroom, at least on paper.
Yeah, I think it's a couple of billion. I think it's interesting just how quickly the maths all adds up. OK, you were mentioning what was happening yesterday with LVMH. Massive day for the luxury sector, big day for LVMH. But is it going to last? Pernod this morning is delivering some weak numbers, and LVMH and Kering have both got Berenberg downgrades after yesterday's big rally. We'll talk about that. We'll talk about the drinks business in the States. LVMH sounded more positive. Pernod is not sounding positive at all. Up next, we'll also keep an eye on what is happening with the Fed trade. What is going on? It seems like it's AI versus trade this morning. AI is just winning in terms of what I'm seeing on the screens in front of me. It feels like a more risk-on session. You got any questions? IB Plus BBTV Go is the function. We look forward to hearing from you. This is Bloomberg.
Looking ahead, however, layoffs and reduction in hiring plans due to AI use are expected to increase from everything I hear. especially for workers with a college degree. It's that disruption of expertise, and a college degree is a form of expertise.
So that was the Fed Governor Christopher Waller, who'll be on Bloomberg Surveillance later today at 12:30 p.m. London time. He's also going to be sitting down with Tom Keene for about an hour-long conversation, so tune into both of those. But Val, you've got markets keeping a keen eye on the Fed, but trade seems to be the major market mover this week.
Markets are desperately at least attempting to try to make up the gap from Friday. Yesterday, they put in a good effort, up 1.2% at the peak of the session, but most of that was taken off the table. We still have around a 1% gap between where we're trading now versus where we opened on Friday before Trump unleashed all of this trade war. Now, there has been a lot of equity volatility, but I want to note fixed income has done pretty okay. Yes, the rally has continued, but at a slower pace. But I thought it was very interesting to point out where two-year yields have gone versus year-to-date. We're hovering very close, Lizzy, to year-to-date lows, just a few basis points shy away from where we were back in April. If we break through that, then that's the lowest two-year yield that we've seen since 2022. And this comes alongside perhaps the market getting a bit more comfortable pricing in a few more here and there Fed cuts in between now and next year. There's actually been some front-end pricing for suggesting that the market could be expecting perhaps a 50 basis point rate cut in between now and December. But it's in the options market. It's not necessarily the base case. But again, the front end continues to perform very well this week. Guy?
Valerie, thank you very much indeed. Our next guest doesn't see a bubble and thinks a Goldilocks picture is starting to emerge. Ben Gutteridge, Markets Insight Strategist, Invesco Asset Management, joins us now. So you're feeling quite positive then?
Well, it's great we can mark today as the start of the end of my career by saying, we're not in a bubble. But yeah, I mean, I think the Goldilocks angle that I present has merit. You know, growth is resilient, jobs market weakening, growth resilient, inflationary pressures fading. You know, there's some debate to be had on all of this, but gives the Federal Reserve room to cutting into an environment where growth's okay. That supports the stock market, and like the earnings picture, remains pretty buoyant for the AI sort of kicker, or even more than the kicker. You know, but so we're feeling relatively comfortable with stock market strength at the moment. Of course, seeing a bit of volatility at the moment, the trade complications, but no.
Does it get bumpier from here, though? Okay, so the end point, let's say a year out, we are higher. What does it look like between now and then? Is it a smooth line? Can I just kind of sit back, take it easy, eat my porridge, enjoy the Goldilocks?
Well, I mean, higher valuations aren't necessarily intimidating for us in terms of, you know, medium-term stock market performance, but of course they leave stock markets more vulnerable. And I know it's getting more and more column inches, this sort of threat of a melt-up in markets. The melt-up in markets in 1999 and sort of the months prior, they were very violent markets, and so sort of sitting back and relaxing is a difficult thing to do. You would expect...
So you're not relaxed?
No, very tense. I don't know if you can tell, but comfortable that markets can perform, but looks as though it could be, and history suggests these periods can still be pretty volatile.
Well, you were a bit dismissive of the trade tensions there, so I do wonder what your strategy is on that. Do you just kind of put the trade noise on mute and assume that Trump will chicken out?
Well, I feel like Taco's sort of a little harsh. You know, he gets deals done, and there is incremental improvements, I think, for the US in those deals. But it's not, you know, he's not getting quite the change that he might be seeking or be calling for in the comments that he makes in the press.
But you're not fundamentally changing your strategy because of what happened on Friday, for example?
No, we're not. You know, I think that's sort of a negotiating approach that Trump takes, that China takes, and of course, rare earths. It's so sort of crucial for each economy to be sort of trading those commodities between each other that, you know, you think sort of a deal gets done. But coupled with higher valuations, of course, that leaves markets open to a bit of selling pressure. But no, I don't think we would turn bearish on the idea that this China-US trade spat could be an end-of-cycle moment.
And just where you're waiting for these Fed cuts, do you not think that there is a risk that the Fed isn't as dovish as is priced? I mean, when you look at what's expected for the inflation print, 3.1%, and when the economic data has kind of been supplanted by earnings in the shutdown, you've got Jamie Dimon warning about stagflation. Isn't there a risk there that knocks the rally?
Yeah, I think stagflation is definitely a risk. You know, we wouldn't be minded to believe that growth is about to sort of fall off a cliff. We see labour market weakness, but we don't see off the charts sort of firing here, and it's a low hiring, low firing environment. But if we were to get worse growth outcomes than we're expecting, coupled with more inflation, then yes, you do get this more hawkish Fed. But if we're talking about just a slower, more cautious cutting cycle, because growth's okay and there are sort of lingering inflationary concerns, we think the market can deal with that and has dealt with that in the past.
Going back to this AI trade and what exactly the effects of the U.S. economy that AI is going to have, we heard from Scott Bessent yesterday saying that normally after a capex boom, you get an employment boom. He also drew lines to the productivity gains of the 90s, which essentially we didn't even know we were living through until a few years later, not even maybe a decade later. How do you position a portfolio for broad productivity gains in the labor force?
Well, I mean, I think the starting position is to take, an overweight to equities. I mean, sort of the evidence is relatively clear, although please, of course, challenge, is that, these tariffs are being paid and earnings and margins are still strong. So to me, that's sort of a pretty stark picture.
You think that's AI?
Well, I think it has to be a reasonable part of it. Yeah, I mean, we looked at the bank's earnings yesterday, and of course, Jamie Dimon talking as always, but lots of interesting things to say. But the amount they're putting into, they're investing in AI, they're almost equaling the amount of money they're saving in costs. So there is a broadening out of the AI adoption, and so it's a really powerful earnings story, and so there's productivity there, and so equities are a nice way to play that.
Do you think there's any risk that this AI spending, all the investment into infrastructure, could be in some way masking more weaker parts of the U.S. economy?
Well, I mean, what we tend to look to for the cycle in the US is sort of the housing market, and there's definitely sort of weakness there. The mortgage rates are at a punishing level, but they're coming down, and there is, we're not expecting sort of a boom from the housing market, but the mortgage rates gently ticking lower. Yeah. There is sort of pent-up demand for housing, so whilst there is an offset, well, more than an offset from AI. Maybe housing could enjoy a modest recovery from here.
Yeah, what I thought he said on AI was really interesting. I would have thought it would. You get a capex boom, but this is a capex boom that's going to generate pieces of kit that aren't going to need many people to run them. Where does the employment benefit come from the AI investment?
No, that's a good point. I think he was generally speaking in history, capex booms have always led to an employment boom. He was looking at past examples of big capex spending, give it the Industrial Revolution or the fiber revolution of the 90s.
But this feels like it's a different narrative. Yeah. In fact, we're trying to maybe dismiss people rather than create jobs for them. Well, so it's I don't know how those two things fit together.
I think you need to separate, though, building out these data infrastructures, which, yes, there's not going to be a lot of workers in these data centers, but you're going to have a more productive workforce off the back of it, generally, across the broad.
But that doesn't improve employment. Productivity means I can do more with less, doesn't it?
Less people.
Yes.
Fewer people.
Exactly. So maybe that's
your margins can be a lot juicier, and you can hire more people off the back of that.
Maybe that's the story. But actually, in a declining, when you've got the demographics that we've got at the moment, maybe that's what ultimately you still need.
Well, Ben, you're confident. It's been good having you around the table. Ben Guttridge, market insight strategist over at Invesco Asset Management. Always a pleasure. And coming up, we're going to go back to Metals Week. That's next. This is Bloomberg.
Uh, 30 minutes to the start of cash trading here in Europe. Quick look at futures just to tell you kind of what is going on. US futures are a little positive right now. We're not up by much, but the Nasdaq's up by 0.3%. Are we going to fill the gap today? Doesn't feel like it. Yes, I'm talking about the Friday gap here, of course. European futures are much more mixed and look a little soft. Not by much. Again, down 0.2%. Doesn't feel like we've got a clear sense of direction this morning. And as I say, and as Val's been pointing out, there's a gap to be filled, and it hasn't been filled yet.
Yeah, just around 1% in S&P Futures from Friday's open. We take a look at fixed income. We are broadly stable. We do see yields creeping higher in France, though. They're underperforming. Those French 10-year yields are 1 basis point higher. Remember, we do look forward to these votes of no confidence for the newly reassigned French Prime Minister earlier this morning. We'll bring you an update on French politics in just a moment. But broadly, fixed income looking pretty steady this morning.
Let's talk about where we go next and what is going to be driving these markets. You've got the AI trade on one hand. kind of looks good this morning, TSMC. Then you've got the trade story on the other hand. And at the moment, the market is focusing on that, not that. President Donald Trump says the US is, though, locked in a trade war with China. He made the comments when asked if the world's two largest economies are in a sustained trade dispute.
Are we in for a sustained trade war with China?
Well, you're in one now. Look, we have 100% tariff. If we didn't have tariffs, we would be exposed as being a nothing. We would have no defense.
No defense. Tariffs equal a defense. Earlier in the day, of course, and that came after the market closed, those comments from Trump's Treasury Secretary Scott Bessent had suggested, hinted at a longer trade pause with China, saying it's possible. He's basically trying to resolve this conflict over critical minerals.
Right now, we are currently in a 90-day roll on the tariffs. So is it possible that we could go to a longer roll in return for a delay? Perhaps. But all that's going to be negotiated in the coming weeks.
All feels quite tense, though, doesn't it? We feel that we're building maybe towards that big meeting between Trump and Xi. Is it going to happen? Chips are being stacked on either side. How those chips are going to be played, with what hands are they going to be played, remains to be seen. Let's figure out what is going on here. Bloomberg's news desk editor, Jill Thesis, joins us with more. Jill, so everybody's trying to figure out where we go from here. Does the tension just continue to be ratcheted higher and higher?
Well, I think, Guy, at this point, look, we're still about, 2-3 weeks out from this potential meeting between Trump and Chinese President Xi Jinping. Clearly, we've seen that escalation of tensions, I think, honestly, mostly linked to that rare earths issue, which really does seem to be the sticking point between these two economies. What China announced last week, that idea of implementing these new export curbs on rare earth materials, I think that was really a bit of a jolt there, right? Because the initial conversations earlier conversations that the U.S. and China had this summer in Geneva left the U.S. certainly with the impression that China would continue to allow the export of rare earths with fairly minimal restrictions and curbs. So the idea that that could be changing, I think, is leading to some of that ratcheting up tensions. But broadly, I think, Guy, the way to really look at this is you do have these two sides kind of just putting what they've got on the table in terms of leverage in any kind of a trade deal. You've got, the U.S., whether it's Trump announcing the threat for cooking oil restrictions or the 100% tariffs that he's talking about. You're talking about, these maritime restrictions that we've seen both the U.S. and China bat about over the last couple of days. It's sort of like an out in the open negotiation. But I think at this point, you're still eventually leading to that Trump-Xi meeting unless something changes really, really dramatically. But I do think, obviously, as we've been seeing, there's certainly some pretty significant sticking points here.
Yeah, Jill, that's right. That Trump-Xi meeting, whether that's on or off, I think is a really key focus for the markets. It is looking like it is still going to happen. But who should we be listening to? More on the Chinese side, or Scott Bessent essentially confirming the deal, the meeting is still on?
Well, I do think at this point that, Bessent saying that they're continuing to, potentially hold these talks is pretty interesting information. That's valuable information there. I think that really, if you're trying to make sense of all of the comments that we heard out of Washington today, Trump's really just, reaffirming what we know, which is that the U.S. and China have been in a trade war. We've known that for months, if not years, right? Like, this kind of dates back to the, first Trump administration. I think what Bessent said about, that idea of potentially rolling over the 90-day trade truce, that's really, really interesting to me. So he kind of tied that to the idea of if, they can reach some kind of an agreement with China on the rare earths issue, maybe that's something that sort of enables that pause. So in that context, I think you're still ultimately heading toward that Trump-Xi meeting, again, unless something really dramatically changes. But still, to me, the rare earths issue, that is absolutely Beijing's biggest point of leverage that they have in any of these trade negotiations. So I think, it's obviously that the Chinese are going to continue to sort of hold that up as that major card that they have to play. How much that actually leads to something that, you maybe see a Trump-Xi meeting and then you get some kind of a truce, at least in the interim, maybe, we'll see that. But I think all of this really does underscore the point that the U.S. and China is a very, very complex trade relationship. This isn't something that you can just resolve in a matter of days or weeks or months. This is something that could potentially take years to ultimately, sort of untangle here. So I think we're still in for quite a lot after this.
And indeed, it already has taken years. Bloomberg's Jill Desis, we thank you. Export controls versus tariffs, we'll see who will win. But trade growth and broader geopolitical tensions have helped drive demand for gold in recent months. Spot gold looks set for its first 10-week run in 45 years, barring a crash tomorrow. We're at $4,224 a troy ounce right now. And to discuss, joining us around the desk is Michael Widmer, Head of Metals Research over at Bank of America. Happy Metals Week. Thanks for making it in. I want to start with the debasement trade, because Scott Bessent, the US Treasury Secretary, basically denied that it exists yesterday. He says people aren't buying gold because of some concern about the dollar. So I want to ask what the debasement trade means to you, whether he's wrong.
It's part of the story, but I think there is much more to it. So we have been bullish for the last $2,000 pounds. I think the first time we turned bullish was really when we looked at the US fiscal outlook, rising debt levels, and at that time I think the Treasury market started to show concerns about that. And then obviously Trump came into the office, has a weak dollar policy, you're starting to balance the current account, means you need less capital inflows from a central bank perspective. That makes it hard to keep recycling US dollars into US Treasury, because everything that is happening is going to be harder or less of a priority anyways going forward. And so the debasement trade matters in a way, but I don't think it's the only thing. I think it's the entire policy package, the economic policy framework that we have that is really supportive. OK, so where gold is rallying, does that continue? Is it more than just your average rally? Is it more than a cycle, or is a price drop inevitable? No, look, the way we look at it is overbought at the moment, but it is still underinvested, basically. So I think so nothing has changed for me. For the last $2,000 pounds, we've been bullish, and everything that took us here is still quite bullish. When we're looking at client portfolios on the wealth management side at Mel's, for instance, the highest we've ever had in terms of gold allocation is about 1.1%. Right now, we are 0.5%. So you still actually have space to increase. One point I would make, though, ETF inflows last month were up 880% year over year, and that is ultimately a concern. I think you can't compound growth at 880% forever, so at some stage you run into an air pocket then and end up in a situation where gold might not rally. But I think from a pure fundamental macro backdrop, we're still looking good. So you buy dips? I would. Potentially, yes. I think. What is a dip at this point? What is a dip that kind of would be worth buying? Look, you have got weekly price movements of $100, $200 pounds. I think if you go down that much, that potentially is a dip. Okay, so there are entry points. Do you see more volatility? Do you see that potential coming? Yeah, I think the volatility we're seeing picking up actually. Right, so the entry points are coming. The entry points are coming. Yeah. Is this a speculative? The debasement trade, it has this kind of fundamental kind of theoretical underpinning to it about kind of what's happening with fiat currencies and debt and all that kind of stuff. There's another argument that says that gold's just a speculative asset. Look, it is an asset, I think, and it has a role to play in portfolios. For instance. Yeah. So take an average central bank portfolio. The best portfolio you have, or the highest risk-return profile, or best risk-return profile you have, if central banks hold 30% of their assets in gold. Right now, they hold between 10 and 15%. So from a diversification perspective, it actually has a role to play. But I agree with you. In the real economy, it doesn't really perform anything. But you still get some kind of price exposure when you have got in your portfolio, right? Okay.
Michael, I want to turn to how some of these metals are exposed to the AI trade. We had the Trafigura economist around the table yesterday saying that copper is particularly exposed to any pullback of this AI trade. How are you viewing how metals play a part of this AI revolution?
First, you won't have any AI if you don't have metals. I think this is one thing. And it's interesting in your previous conversation that you have when we're talking about rare earth elements. I mean, that's one of the building blocks for the economy. I think when you're looking at the Department of Energy had a resource adequacy report out on the basis that we're not investing enough in the grid, in electricity. That again is metals intensive investment. On the current trajectory, the Department of Energy said that they're going to lose, that the US is losing the AI race against China. And I think this is where metals come in then. So every country is now, it's not AI necessarily, but every country is electrifying the economy. And that's, I think, where the metals demand comes from. And this is why metals keep holding up.
So is China winning the trade war?
I think they are going head-to-head. They're going head-to-head at the moment. I think Europe is coming in, obviously, as well now, right behind. But that's the point, right? Everyone is pushing ahead with it. And that's where you get a structural demand growth for metals coming through.
Out of interest for the broad AI trade, do you see any bottlenecks in mining production or getting the appropriate metals into the appropriate regions that could maybe cause some hiccups in supply?
We're seeing them at the moment, right? I mean, the one where we are concerned now is copper. And I give you an idea. We have mines, the biggest mines currently having outages and disruptions. If you look at the equivalent in the oil market, that would be the equivalent of Saudi Arabia actually having outages, and the market would take that not very well. And the same is on the copper side. You have structural issues in mine supply. You don't see the supply growth, and at the same time, you keep adding to demand. And that's, again, we had a trade dispute for the best part of the year, and copper did not go down.
But bottom line, is it these rare earth export controls that's going to blow up the AI trade?
Not necessarily. I think you can look actually at the entire package. I think on the rare earths, as you said, I think China is effectively losing the leverage, and the US and Europe have been very negligent in building their wider basic materials, raw material industries, and now need to catch up on that, I think.
The question, everybody's trying to figure out what the bottleneck ultimately looks like. And it becomes slightly circular. There's so much momentum in this trade at the moment that it's driving kind of huge amounts of demand. But it feels like a momentum trade. There's so much planned, so much expected. It's hard to know kind of whether or not that is going to be deliverable at the moment. And
maybe the bubble is in these power trades.
Well, precisely. So that's that takes you into other areas.
And I would agree with you on that. I think in the US, for instance, we're talking about can we build aluminum smelters because we want to rebuild the supply chain. But the AI, the data centers, paying prices for the power that the smelters just can't. In the end, and so you end up.
Someone's promised something they can't deliver somewhere in this
chain. The circle
chain.
doesn't quite. Does the circle of kind of everything that is required to keep it going doesn't? There's so many kind of elements within that could fall apart because, well, power's one of them.
Yes.
But just getting the stuff into the system to allow it to deliver feels like a real challenge at the moment.
It is a real challenge, and I think that's something. Just from a metal, bring it back to the metals again.
Yeah.
That's something why we have actually not kind of removed our constructive outlook for the metals, because you can see that need to get stuff into the system coming, and you need to increase.
But if the AI story starts to fall apart, does the copper trade fall apart?
Well, look, I think the AI trade. But
this is.
But it's not just the AI trade. I think a broader theme. I think we've talked about ESG, say 2 years ago. The ESG trade is taking a little bit of the backseat. But what is still on is the electrification trade.
Yeah.
We are electrifying global economies. And I think that trade, with or without AI, I think is going to continue going.
All right, so we need the electricity with or without the AI boom behind it. Michael Weidmer, thanks for joining us around the table, the head of metals research at Bank of America, in town for the London Metals Week. And I've been hearing like snippets from the IMF this week that everyone's first question is, why is gold going up?
Right. Which kind of, yeah.
Well, they're all
We've
central
asked that
bankers,
question,
right? It's them.
Well, they're partly responsible, yeah. The gold trade is certainly being driven not by maybe Western central bankers, but they are playing their part. But it's everybody else. But it's a speculative trade. So there was a piece by, who was it the other day? William Boyter, Bank of England's kind of well-known guy in the market a few years ago, talking about the fact that central banks should be selling right now. Anyway.
Well, it's funny that you call it the speculative trade, because we did have some gas taken out of the NASDAQ last Friday, and gold still did very well. So there's clearly something else.
No, I'm not denying that, but is the price action at the moment is extraordinary.
Well, that's
more buyers than sellers, as Scott Bessent said.
But silver is the one that doesn't have the central bank anchor. So is it silver that loses its limits as a haven?
Well, coming up on the show, Nestle plans to cut 16,000 jobs as the new CEO seeks to accelerate a turnaround at the Swiss food maker. We'll bring you more details next. This is Bloomberg.
11 minutes until the cash market open here in Europe. Let's figure out what we are focusing on this morning. Is it the trade narrative or is it what is happening on the AI front? Let's try and answer that question right now. Bloomberg's executive editor for Asia Markets, Paul Dobson, joins us now. Which side of the fence are you on this morning, Paul?
Morning, Guy. Well, I've been saying it for a while. If in doubt, buy the chip, you know. And lo and behold, again today, we have gains in the AI space right across the Asian complex. Some optimism there from the ASML earnings, from the TSMC earnings that we've just had as well, and the outlook there, all looking upbeat. And so that tech story continues to unwind. And the thing is, you know, these solid earnings are giving people confidence, even though the backdrop that we have with all of the trade angst and uncertainty continues to weigh on people's minds. I was thinking about it as I was waiting for the hit, thinking, how do I really think about what Bessent said overnight? The US is hanging out the hope of some sort of negotiation. China obviously would prefer that as well. So we'll see. There's good mood music, but at the same time, there's that background of escalation if it does go wrong. So people, I think, are choosing to follow the easier narrative at the moment, which is look at tech, look at the fact the Fed is going to cut, and follow your instincts.
And Paul, we've got also some traders seeing a jumbo Fed cut before the end of the year, maybe more than one. How seriously should we take those wagers? What's driving them?
Well, I think that what's driving them is the prospect of an extended shutdown from the US government that not only muddies the data, but then starts to weigh on confidence in the economy if it really does go longer term. You know, what we heard from the Fed policymakers this week gave everybody confidence that they would go for 2 cuts at least, you know, sort of by the end of the year. And the idea that they could go more aggressively in December if needed is part of that sort of equation now. On the other hand, you know, these are cheap lottery ticket type bets. They're not kind of serious amounts of money going through, I don't think. And the idea is that, you know, you might get lucky, or it could be a useful hedge for your portfolio to pick up these things. Nonetheless, that's the, you know, sort of like the confidence that the Fed is going to cut interest rates. It's weighing on the dollar a little bit, giving the rest of the global markets a little bit more of a boost as well.
Paul, what do you think about the yen here? You know, we crossed the 153 handle on dollar yen just, a week ago. We're now back at 151. What's the latest read on the politics situation?
Yeah, great question. It's a little bit murky still, but it does seem like Takaichi is back in the driving seat here. All she needs is for one of the 3 sort of large competitor parties to either duck out of the vote and abstain, or to back her, and it looks like Ishin is leaning in that direction. And then, you know, that should propel her to power, albeit without a very clear majority and still a shaky hold on power. But if you see that, then the market is minded to push Japanese stocks higher in the idea that she's going to be stimulative for the economy, but may also drag on the yen again and weaken it back lower, as well as pushing government bonds. Well, you know, the up and down, it's a little bit more of a confusing one for that, depending on how much they actually decide that they need to spend.
All right, now on the Japanese politics, Bloomberg's executive editor for Asia Markets, Paul Dobson. Thanks for joining us this morning with your thoughts on the market. Now let's get your stocks to watch ahead of the cash equity open here in Europe with Chloe Melly. Chloe?
Good morning, Valerie. Nestlé could be on the move today after reporting stronger than expected sales growth and also announcing it will cut 16,000 jobs over the next 2 years. So this is a massive headcount reduction, and we could see that boosting the shares this morning. We've seen a bit of weakness over the last few months for Nestlé as it really struggled to revive volumes. And of course, as we all remember, also fired its CEO in September. We know as well that there's still kind of a long way to go for Nestlé if it wants to catch up with its closest rival, Danone. But we'll see how the market kind of digests and reacts to this attempt of turning things around by the new CEO. Moving over to Nordea. Nordea is the first big European bank to report, and it seems quite positive. So it announced a 250 million euro buyback. It also said that net interest income beat expectations because of this renewed appetite for investment among Nordic companies. So that bodes quite well for that broader European banking sector. And for Nordea in particular, that might mean that it will continue to outperform that broader banking and financial services sector as it has been over the last few months. And finally, it was such a good day for luxury yesterday, perhaps not such a good day today. LVMH and Kering were both cut at Berenberg. Kering cut to a sell rating, LVMH to a hold rating because of structural demand issues in that sector. So we'll see how much of a weakness we get from LVMH and Kering. Hermes and Brunello Cucinelli were being selected as top picks by Berenberg, so they might see a little bit of a boost this morning. So let's definitely keep an eye on that luxury sector after such a good performance yesterday.
All right, Chloe Melly, we thank you so much, our equities reporter. We've also, of course, got to keep an eye on chips and tech here across Europe because we've had those very, very strong results from TSMC this morning.
Absolutely. You could also argue there may be some movement in the oil stocks. I don't know yet. We're going to watch. There's been the Indian story this morning, which is worth focusing on. There's also been the UK looking at Chinese refineries as well in terms of what it's doing on the sanctions list. So that's probably worth focusing on as well. Not much movement, but could just be at the margin one of those stories that maybe moves some of these oil stocks and therefore has a disproportionate effect maybe into the London market.
Well, it could be TSMC that really keeps the market narrative squarely on tech and less about worries over trade. Let's see if there's any follow-through today to the likes of ASML or ASM for those positive TSMC results that saw profits surging by 39%.
Yeah, the CEO saying developments in the AI market are very positive, but capacity is very tight. Let's see how the market likes it. We're getting to the opening trade. Stay with us. This is Bloomberg.
So, yesterday's session, a bit choppy, but didn't actually take us anywhere and certainly didn't fill the gap that we've still got to fill from Friday. That's the takeaway from yesterday. We were pulled this way and that way, AI, trade, lots of things going on. The net result actually wasn't very much. We kind of just really went sideways, certainly on the US session. European equities were much more positive yesterday, and that was actually driven by earnings, which was largely a story surrounding what was happening with the luxury trade. That doesn't feel like it's going to repeat today. But the big takeaway, Val, is still that we haven't filled the gap.
Haven't filled the gap from Friday. Still 1% to go on S&P 500 futures, but we might still see some decent trades in luxury today. Look at the outperformance of CAC 40 futures, up 0.25%, while the broader Eurostoxx 50 futures in the red, down just less than 0.1%. FTSE 100 futures essentially going nowhere quick either. Lizzy, what kind of stocks are we watching at the open?
Well, of course, we have to look at the chip stocks. We've had those very strong results from TSMC earlier in the day, and we've had also ABB orders jumping on demand for power-hungry data centres. We'll keep an eye on Nestle too. They're slashing 16,000 jobs as this new CEO steps up the turnaround. And we mind the luxury stocks too. Berenberg saying that the super cycle has ended after a whopping great day that we saw for the CAC 40 yesterday off the back of LVMH surprisingly returning to sales growth. Guy, we're getting closer to the open.
We are. Looks like it's going to be a fairly meh kind of open for European stocks, but we had a decent session yesterday. We've still got to fill the gap from the sell-off that we saw on Friday when it comes to the United States. That is a challenge, it seems, at the moment. We're pulled between trade and tech. That seems to be the narrative the markets are working with at the moment. It does feel this morning maybe that tech trade is the one that wins, so keep an eye on European chip stocks at the get-go of trade this morning. Talking of which, here we go. It is time for the opening trade. FTSE 100 flat as a pancake as we work our way through the opening seconds of the session. But actually, I want to dig into the details of what is happening below the hood when it comes to UK stocks this morning. I think there could be some really interesting trades going on there. In terms of what else we're going to be watching out for, keep an eye on what is happening with Nestle down on the shores of Lake Geneva at Vevey, making some big job cuts coming through. Will the market reward Nestle as a result of that streamlined process that is underway with the company's new CEO? The CAC 40 is up by 0.2%. A little bit of outperformance coming through there, but maybe not that much. The IBEX is also up by 0.2%. We have the Lecornu votes coming up, the 2 votes of no confidence in the National Assembly in France, which will bring some live shots of very shortly, we think. So that's the picture we find ourselves with at the moment. From an index point of view, not a lot to see here. From a sector and a stock point of view, I suspect the action is going to be a little bit more exciting. Val, what are you seeing?
Well, look, when it comes to the sectors, the top of the basket is banks. So Nordea leading gains in the banking sector this morning. They were one of the first European banks to report overnight. Their shares are up around 4%. So banks, the top performing sector at the moment. We also have to talk about tech because ASML doing okay this morning. The shares opened up 1% in the broader tech. Excuse my words. It's now flipped into the red. So perhaps the read-through is still being digested from the TSMC earnings in into the tech space here in Europe, but broadly fairly positive when it comes across to the indices. When it comes to the single stocks that are open, we have 345 in the green, just less than 200 in the red at the moment.
Well, at the bottom of the basket, we have travel and leisure, consumer products and services, and I had pointed to what you might see in terms of luxury. Kering down 1.5%, LVMH down about 1/3%, Hermes down more than 1%. So Berenberg, as it seems, is correct at the moment to a degree, the super cycle having ended, but at least just a little bit of misery for now. When you look at some of the other stocks to watch, Nestle not yet open, but ABB, of course, did have orders jumping on that demand for the data centres, and those shares up 1.3%. Whitbread really suffering today. This is a UK-listed stock, down more than 6% at the moment. This is the owner of Premier Inn here in the UK, so that's probably partly what's doing a disservice to the travel and leisure stocks.
Yeah.
But they had slightly better than expectations results, but cut their guidance for the German business because of the softer than expected demand there.
The tech trade is on. ASML is the biggest points gainer in Europe this morning. It is percentage-wise not up by that much, but it's the biggest points gainer. Schneider, which basically provides kit in for the build-out of data centres, is up quite nicely as well. Siemens is up, doing quite nicely. So there's a bunch of tech trades that are definitely on this morning. It's interesting, actually, that oil stocks are also on the front foot. ABB is doing reasonably well. ABB on the back of its numbers. Just coming back to this luxury trade, though.
Yeah.
Yes, we're down.
Not by much.
LVMH on a 3-day chart I've got up here is still up by 10%.
Yeah, Kering just down by 1.5%. Same with Montclair. Hermes down less than 1%. So holding on to decently to the gains yesterday.
Big gains from yesterday are being held on to. So I think we just need to kind of bear that in mind when we look at maybe some of the more downbeat commentary that's coming through from Berenberg.
Maybe just a bit of a reversal from what we saw yesterday. It was such a fabulous lift yesterday.
Look at the 3-day chart. We're well within the range of where we were yesterday. We are in the top kind of 1% of that range on the chart.
Well, look, speaking of earnings, we spoke to Christian Muller-Glissman from Goldman Sachs yesterday, and he shared his view on what to expect from this earnings season.
The earnings season, I think, will be critical because it's the first time we're getting more data, understanding how strong the corporate sector really is. So I think that will dominate. There's a lot of uncertainty on politics and geopolitics, as always, and you kind of want to be careful about making too many shifts on your portfolio based on that. So we're still modestly pro-risk, if you're asking how we're feeling, and we're going into this earnings season with a view that it kind of probably will validate that the corporate sector is still in relatively good shape.
Joining us now for more is Karen Ward, EMEA Chief Market Strategist over at JP Morgan Asset Management. Always good to have you with us, Karen. How are you feeling going into earnings season? Because, of course, it's even more important in the US when you haven't got any economic data.
Yeah, absolutely. Two big questions for me in the earnings season. One, on the US side, what do these tech giants start to guide us and start to give us a flavour of what the end demand for the product is? I mean, I feel like, just stepping back from this whole tech theme, what we know is they are investing massively in the producing of these capabilities. We've had these data centres that have been built out. They're enormous. That's helping all of the chip producers, etc. But now we are at the tricky bit of a tech cycle, which is we need to find out what is the demand for these technologies, and are companies really feeling they're going to be able to take out big swathes of their workforce because of how AI is going to power their business, and therefore they're willing to pay big for it. That's always the tricky bit. And so anything that I'm seeing in their guidance about revenues, we want to know about the end demand. And I think my nervousness would be that every earnings cycle up to now, they've sort of created this enthusiasm by saying that this is the hyperscalers. I'm so confident, I'm doubling down on my CapEx again. And the market's kind of gone, wow, they must be so confident. And if they even just say, we're happy with our CapEx plans now, I think the market will sort of start to sniff, what do they know that we don't know? So those are the sort of uncertainties on the US side that just make me, and again, I worried about that last quarter and it didn't happen, so it's not to say I would be particularly underweight, but that's where I think the sensitivity is. On the other side here in Europe, I think we had a very weak earnings season last quarter. Expectations, I think, are still quite modest. And that's where I almost think there's still not enough optimism that actually some of the headwinds that are against Europe will start to alleviate, and we'll start to say, oh, gosh, maybe this German fiscal stimulus is going to start to hit the economy and come through in corporate earnings. So that's why I would say I go into the earnings season leaning a little bit more towards the fact Europe might be our upside surprise.
But so you talk about the demand side of AI. What about the supply side? Because we've been debating whether the rare earths export controls are the bit that blows up the AI trade. And that really could come in the context of ASML. We had results yesterday.
It could do. I worry less about that. I think we already have unbelievable capacity in the US. I mean, what we've learned over the past year, I think, is just quite the scale of what's already been done. Half of US GDP over the last year has been, I think, in this CapEx build-out for AI. So I think it's not like we still need to build the data centers. I think they're ready to go. For me, the nervousness is the end demand for it. And that's where I'm tracking. What businesses are using this? Have they trialed it and are starting to find that maybe it wasn't as useful as they thought? That's really where my attention is, rather than on...
Ken Griffin's struggling with that one.
Yes, we had Ken Griffin saying he's not yet been able to use AI to generate alpha directly, so bots cannot trade.
We've been trying all sorts, and unfortunately for me, when you spit out a report that's been generated by AI, your first read of it is, oh my goodness, I'm going to be out of a job, and then you read it the second time and you go, OK, well, that's factually incorrect, and OK, that's an assertion, but it's not an assertion, there's uncertainties. And on my second read, I thought, OK, now I have to write this from scratch.
Well, Karen, OK, that's how businesses are adopting AI, but what about these partnerships that OpenAI is announcing on trying to use ChatGPT as a way for people to do agentic shopping? They just partnered with Walmart a few days ago. Walmart stock went crazy off the back of that. Is that one side of the AI trade you're watching?
So I think there's a couple of things linked to that. One is, which again I think keeps me in the more nervous camp, is that we sort of felt that a lot of these tech giants had these very clear moats around their business. But what we're seeing now is the likes of OpenAI, as one of my colleagues puts it, sort of changing lanes. The swim lanes are getting a little bit... So in other words, the competition now is becoming pretty acute. And that, I think, is where things are going to get very interesting again in terms of what we're learning about who are the eventual winners and losers. Because, I'm asked the question every day, how does this tech cycle compare to 99, 2000s? And what I always say is that we know the difference is these companies are highly profitable, they've got great free cash flow, but what we know about every tech cycle is the hard bit is understanding the eventual demand for these technologies, and also who is the eventual winner. Is it OpenAI? Is it one of the other Mag 6? And that is where I think is tricky. And then the final thing I would quickly say is, we need to know the demand is from businesses, not from consumers.
Oh, interesting. Why do you think that?
Because consumers don't pay for technologies at scale. It's businesses where the big money comes from. So we need to learn that this is an enterprise technologies that are going to really allow businesses to reduce their headcount, raise productivity. That's what will pay big.
Doesn't Google make a ton of money off the consumer?
I buy loads off Instagram, Karen.
But again, that's a different thing. I think that's, via our traditional channels of advertising. I think really to meet the expectations of double-digit earnings for many of these tech companies over the next few years, it's going to have to come from enterprises. I think consumers, when they end up being a consumer toy, the money's not in it.
Does that mean we're in a bubble? Let's try and... if that's all true, these valuations look quite punchy.
I would say we're not... I wouldn't characteristically say we're in a bubble, because I do think the earnings generation and the fact that this CapEx has been largely deployed from existing cash flow is all very comforting. And I might be I don't know about end demand yet.
Yep.
You know, maybe it is that businesses across every sector, across the entire world, are finding a tremendous use and are going to take out 5% of their workforce, and therefore the demand is going to be big. If that's the case, personally, I'd rather buy European corporates than buy US tech on that, though, because I would say that the US tech are pricing, and also if the two stories can't be right. You can't be pessimistic on corporate profitability in Europe and at the same time tremendously optimistic about tech earnings forevermore in the US. I think those two stories don't fit.
I feel it would be remiss for me to let you go without asking you about what's happening in the UK.
Yes.
My tax is going up.
Yours particularly.
Yes, just mine.
Absolutely. I mean, headline, what I would do, I'm very concerned that the UK is just at the limits of the tax burden it can cope with. And I think what we've learned over the past year, last autumn was a tax to spend budget, and we've learned the economy has really struggled to cope with it.
So if she raises taxes, the Chancellor raises taxes, the market will perceive that as a negative, do you think?
It depends on which ones, but I think the perception will be the likelihood is this could be counterproductive, it would depress growth, and we're going to get to the same point this time next year of talking about now which tax goes up. However, I was very comforted to hear just before she went off to the IMF, I thought the Chancellor really was bringing the spending side of the equation back onto the conversation.
Is that politically realistic?
Nothing is politically real. You know, there's no options on the table that the UK electorate are going to like. I think there are things where, for example, tell the UK population, look, we've got people that pay into the system and the people that take out. And we have to make sure that those that are paying in, the growth of their earnings is what drives the growth of the earnings of those taking out. So I'm sorry, Triple Lock, that's got to go. Your pension's going to go up with average earnings. Benefits are going to go up with average earnings. Delinking everything to inflation, I think actually there's a political narrative there and there's certainly an economic narrative. But don't envy her the job, that's for sure.
No. She's going to have a fun time when she comes back from the IMF.
Yeah, we're on the wrong side of the Laffer curve, essentially, is what you said.
Absolutely.
The left won't like that.
Nice economics right there.
Karen Ward, EMEA, Chief Market Strategist at JP Morgan Asset Management. How much do you buy on Instagram?
Oh, it's my kryptonite. Constantly, Guy, when I'm not sat here with you.
Maybe she's doing it right now. Anyway, while we're focusing on that, and we'll give Lizzy some time to go shopping, we'll look at the Core 6 and figure out what is happening. This is the picture at the moment, and as you can see, it's a mixed one. Nestlé to the right-hand side. Look at that. That is the takeaway of this morning. Nestlé cutting jobs, accelerating the restructuring. The market likes that. And you wonder how much of the jobs that are going to be cut will be done by AI going forward from here. Anyway, LVMH is a little off this morning, but not by much, and holding on to the gains from yesterday. Chips are on the front foot. Let's get more with Chloe Melee.
Good morning, guys. So, as you just mentioned, Nestlé is up massively, almost 8% this morning on the back of that stronger than expected sales growth and also those job cuts. So, 16,000 job cuts over the next couple of years. So, this is really an attempt by the new CEO who joined just last month to really streamline the business and turn things around after a few months of volume weakness at Nestlé. And this seems to be rewarded very, very positively by the market this morning for Nestlé. Moving over to luxury, where we see a little bit of weakness for LVMH and Kering this morning after being cut by Berenberg. So Berenberg analysts cut LVMH to a hold rating and Kering to a sell rating. They said that there was potential structural demand issues facing that sector, that there was continued pressure in China and also a changing consumer behavior among younger generations, and that those two names would be the worst affected. So we see a little bit of the reversal of the really good performance that we had yesterday on the back of the sales update by LVMH yesterday. Moving over to Whitbread, where we see also shares in the red this morning. Whitbread, the owner of Premier Inn, the hotel operator, it reported earnings that disappointed. In particular, what might be driving the shares down this morning is weakness in Germany, where with expectations of a lower profit in that quite important division, even though the company actually reiterated guidance for the entire business. Moving on to Sartorius and its subsidiary Sartorius Stedim. So Sartorius is the makes precision equipment, and then Sartorius Stedim is a subsidiary that makes more biotech precision equipment. Both of those have raised their outlook this morning, and this is being rewarded by the market this morning. We're up 10% and 11% for those two companies. And finally, let's end with another guidance raise, and that is for flatexDEGIRO, which is an online brokerage firm, raised its guidance, and the shares are up 5% on the back of that this morning.
Okay, Chloe Melly from our equities team, we thank you so much for the stocks that are moving at the open. We've also got an eye on France, and we have MPs currently debating a no confidence vote. You can see on the screen Marine Le Pen of National Rally speaking about why there should be no confidence in Prime Minister Sébastien Lecornu. Of course, he has suggested that there be this compromise with the socialists in Parliament, that they should suspend President Emmanuel Macron's pension reform to raise the retirement age. It's a humiliating concession for the president. But if Lecornu can get through these confidence votes, you would think that the Oates-Bunt spread would narrow somewhat. So we're at 78 basis points at the moment on the French 10-year bond yield, up a basis point at the moment. And we were talking about French stocks, the CAC 40 lower 0.1%, but that much to do with the luxury story, as Chloe was highlighting there.
OK. Coming up, let's talk about what is happening in terms of the corporate story that we're watching this morning. We'll park the French politics for now. We'll come back to it in just a moment. Nestlé, 16,000 job cuts at the world's biggest food company. The market likes it. We are going to see a more efficient company going forward. We're going to talk Nestlé and the sales figures and the job cuts. That's all coming up next. This is Bloomberg. Morning, Thursday morning. At an index level, not a lot to see here. At a stock level, there's some fairly interesting price action this morning, which is worth focusing on. Let's start with Nestlé and figure out what is happening there. Better than expected gains in sales. Pricing looks OK. Volume looks all right. What seems to be, though, driving things this morning is they've got a new CEO, and we are seeing significant job cuts. This company is looking to become much more efficient. It's planning 16,000 job cuts over the next 2 years. Swiss business reporter Fabienne Kinzelmann joining us now to talk about this. Good morning.
Good morning. Thank you.
So how's this going to happen? What's the cost of this? That sounds like an awful lot of job cuts to me. I know this is an enormous company, but nevertheless, 16,000 job cuts sounds like a big number.
Yeah, you're absolutely right. That's the talk of the town, right? Besides, like, the already strong...
Certainly the talk of Valerie, I would imagine, this morning.
Oh, yeah, definitely. That's for sure. I mean, they are just, like, they announced these 16,000 job cuts. They didn't announce, like, where exactly it will be. They didn't say which geography region, like, which field. What they said is, like, 12,000 of them will be white-collar jobs.
OK. Is that an AI story? I don't know. But is that where... How easy are they to get rid of? Is this something that is going to cost the company a lot of money in the near term? That sounds like a fairly big transition.
It definitely is. It will come over the next 2 years, and they are actually expecting, like, cost savings. I think it was around 3 billion Swiss francs, which they announced to save till the end of 2027.
And so we've got this new CEO.
Yeah.
You know, they're just a couple of weeks into the job. We had the alleged undisclosed romantic relationship with a subordinate going on with the past CEO. But with the new one, what's his vision? What is it that he wants to do to step up investments?
Yeah. He came in bold, right? He announced the job cuts. He announced a strong third quarter. And the investments, I think they really, like, what was important to him was to lay out they will be... in growth areas. He specifically mentioned platforms, like they are hopping on the air fryer trend, for example, but also on the cold coffee trend, which is big with the Gen Z.
Cold coffee trend.
The cold coffee trend, like drinking cold coffee.
I'm not Gen Z,
no?
Thanks for the compliment.
My bad. I missed that part. But thanks for joining us. That was Fabienne Kinzelmann joining us on the latest out of Nestlé. Now let's turn to tech. We did have TSMC results overnight, and shares have been called higher, but they did post a better than anticipated 39% jump in quarterly profit in the latest sign of the AI boom. The chipmaker also raised its revenue growth outlook for the year and expects annual capex of 40 to 42 billion US dollars. Joining us now for more on this story is Matt Bloxham from Bloomberg Intelligence. Matt, your top thoughts on these earnings today?
Yeah, well, I mean, the capex guide, which has been narrowed to the top end of the range, not surprising because everybody's just throwing more money at this opportunity. And again, probably the upgrade to the revenue outlooks are now mid-30% in US dollar terms. Again, maybe not a surprise, but there's definitely some catch-up for analysts to do there, and an optimistic outlook for the year ahead. And, interestingly, on the call that didn't finish too long ago, much of the Q&A was more about the kind of AI opportunity, rather than historically where you beat people trying to kind of understand what's the demand for the latest iPhone or the kind of, the next big kind of chip driver. Much more about the opportunity.
And they clearly see the opportunity as being big, but are they, the pace of this thing is moving like a freight train. What do they see in terms of the sustainability?
Yeah, I think in the near term they see a very robust sustainability of this because we're still at that kind of developmental stage where people are building the platforms and the capacity to hopefully one day kind of be met by all of the demand. So I think obviously there's some question marks about the China situation from a number of different angles, the constraints about selling technology into that market, China's constraints on rare earth materials and whether that creates a new supply chain glitch for companies like TSMC. But they seem very optimistic that even without China, there's still very robust demand for their platforms. And obviously we heard similar things from ASML yesterday too.
Yeah, because we're always asking for an expert to try and put the food chain together for us of how those rare earth export controls are going to filter through and damage this market. Where does TSMC fit into that? And also, if they're putting money into factories in the US, how can they protect themselves from that?
It's a good question. I mean, they're clearly going to be impacted like everybody else. I mean, even ASML yesterday said that they're going to be constrained if there were raw earth materials supply constraints from China. I think that's going to affect everybody. And, obviously every Western country is rushing to try and find alternative sources for some of those materials. I mean, the US situation is kind of fairly complex for TSMC. You'll see one thing that came up on the call was the rivalry with Intel. See a lot of money going into Intel as an alternative foundry provider, both in the US. Now, TSMC is investing in their own US capability, but they're also going to continue to invest in Taiwan too. So I think that they're going to be investing as much as they can to maintain their lead over people like Intel. I mean, they're over 50% of the overall foundry market right now and spending money to kind of protect that dominance.
But, of course, Intel's got Trump as their pitch man, so we'll see how that race goes. Matt Bloxham from Bloomberg Intelligence, good to get your expertise on this. But coming up on the programme, the French PE giant Ardian has raised a record $20 billion for a European infrastructure fund. And we're going to head to Paris next to speak to Matthias Berghardt. That conversation next. Plenty to discuss. My least favourite word, cockroaches in credit, certain to come up. That's next. This is Bloomberg. This is the opening trade, and we're 30 minutes into today's session. And as you can see, not much doing when it comes to European equities so far. Trying to make our minds up, aren't we, about what's happening with trade, the US and China blowing hot and cold at the moment. We've got a lot of earnings to digest as well. But the CAC Cajon only down 0.1% at the moment. We're holding our breath to see what happens in the French National Assembly when it comes to those votes of confidence in Prime Minister Lecornu. Guy, what's happening when it comes to the look under the hood?
There's an excellent fight developing in the French National Assembly right now. We'll come on to that in just a moment. So Stoxx 600 up 247, down 327. So we are reasonably balanced. The down has it, but only just. Volume's actually fairly reasonable at the moment. Val mentioned this a while ago. Nordea is the stock that actually stands out at the upper end of the stock story this morning, and it is hitting a 52-week high. You can see the Scandinavian Bank up by nearly 40% so far this year. Bank's been a really big driver. Ironically, the French gaming and lottery company FDJ is the loser this morning in terms of the 52-week lows that we've pulled out. The stock has seen a downgrading of expectations, and that stock has taken a decent, like it took the big chunk down in February, but we are now continuing with that move lower on the back of the latest update from the company, and we are down on a year-on-year basis by 25%. So that's what is happening in the single stock story. What else do we need to know this morning, Valerie?
Well, here's what else you need to know this morning. U.S. Treasury Secretary Scott Bessent has flagged the possibility of extending a pause on import duties on Chinese goods for longer than 3 months. Speaking at a press conference in Washington, Bessent said the truce would be on the condition that China halts its plan for strict new export controls on rare earth elements. The comments came as President Trump confirmed to reporters that the U.S. and China are in a trade war. Traders have been piling into wagers, calling for at least one outsized Federal Reserve interest rate cut by the end of the year. Activity in options linked to a secured overnight financing rate shows a buildup in positioning for a half-point reduction, either when the Fed meets later this month or in December. That's two more than the two quarter-point cuts now priced into interest rate swaps. And French MPs are currently debating the two no-confidence votes facing Sébastien Lecornu. The French premier is expected to survive the motions after announcing plans to suspend a contentious pension law. Lizzy?
Well, we can see the debate happening in the National Assembly, and we've been hearing from Marine Le Pen. She got a standing ovation from her part of the National Assembly, but we'll have to wait and see whether Lecornu can survive these two votes. I'm sure that we will see a narrowing, perhaps, of the spread against German bonds if we get victory.
There was a fantastic moment a few minutes ago, which we didn't manage to catch on camera, between Le Pen and Lecornu. She spoke first.
They fist bumped, did they?
Well, no. She made a speech, went back to her seat, got a standing ovation from her little slice of the French Parliament, and then he stood up, and they were basically kind of jockeying with each other in terms of him going, we've got a stable government here, and she's going, where is that in the rest of the French Parliament? Anyway, Caroline Carnan, I'm sure, was monitoring all of this for us. Let's go to Paris and get the latest from her. So we've just seen a really interesting interchange between these two, and I'm wondering what that tells us about what we can expect for the rest of the day.
It's interesting because you were talking about the lottery company just a few moments ago, and some Renaissance MP was saying yesterday, it's like a poker game. You need to pay before you play. That's what Lecornu has been doing by giving away this pension reform in order to get the support of the socialists. At the moment, these two motions of no confidence proposed by the far left and the far right of Le Pen are being debated in Parliament. We should hear what the vote comes out in the next probably half hour, 1 hour. No more than that. It's going to be quick. And in fact, Lecornu should survive these two motions of no confidence, but it's going to be very tight because you need 289 votes in order to make the Lecornu government collapse. And even though the socialists have said they will not support this motion of no confidence, there is a bunch of rebels within the Socialist Party. At least 4 of them will still support the motion of no confidence. There are also at least a couple among the Republican parties. So Lecornu should survive, but by less than 20 votes. So you can imagine how difficult it's going to be as well over the next few weeks, over the next few months, to vote on anything and to pass any kind of budget.
And so we get the updated ratings, Kathleen, of French sovereign debt, both from Moody's this month and from S&P next month. Where the compromise has been is on suspending the pension reform, as you say, but what's the cost of that for the finances of France?
Well, according to Lecornu, it's going to cost 400 million euros next year, 1.8 billion euros the following year. Of course, the budget impact will be bigger in the longer term, as much as 15 basis points on French debt, according to our own Bloomberg economist. Of course, the compromise will also come on the tax front. You know that the socialists have been pushing for the so-called Zuckman tax, this wealth tax on assets of more than 100 million euros. Even though the National Rally said yesterday they will not support this Zuckman tax, the rally that we saw yesterday in the luxury sector and LVMH soaring might not actually help Bernard Arnault and his luxury conglomerate, because the market cap of LVMH increased by nearly $20 billion. And that's perhaps something that the socialists will debate also when they want to present the Zuckman tax.
Yeah, that made the timing a little bit more difficult, didn't it? That big rally we saw yesterday in LVMH. Caroline, thank you very much indeed. Caroline Conan joining us from France on the latest surrounding the French politics story. With Lecornu dropping Macron's pension reform but keeping corporate windfall tax proposals in order to win today's vote, French business leaders are feeling un peu betrayed. However, our next guest still has a positive outlook. Matthias Burkhardt is the French CEO of the private equity giant Ardian, and that company this morning announced it has raised the record $20 billion for its latest European infrastructure fund. Good morning, Matthias. Thanks for joining us. We really appreciate your time this morning. We'll come on to the French politics in just a moment because there's a number of interesting questions around it. But let's start off with the fund that you've raised and your outlook in terms of the industry. It's interesting. At the moment, it seems as if European private equity funds are maybe able to raise money at the moment because they're European, which sounds slightly counterintuitive. But Europe feels like the diversification trade right now. Is that making your life easier?
Good morning, guys. Yes, absolutely. I think we are first of all, we are very happy with this success. It's not only a big number, 20 billion, but it's also doubling compared to the previous generation. I think it's some different things explain this very positive outcome. First, as you said, I think there is a willingness of global investors, and we raised more than 60% of the fund outside Europe, to diversify, and probably they were under-allocated in Europe in the past, so they decided because of this current environment, which is very difficult to read and very difficult to forecast, to be diversified. And Europe, after all, is a stable place, even though the economic growth is slow. The other factor is that we are investing in the mega trends of our economies, which are obviously the connectivity, physical connectivity with the transport. As you know, we are the main shareholder of Israel. We recently announced the acquisition of a group of airports, including Venice, but also the virtual connectivity with data centers, fiber, all the digital infrastructure. And the enabler of all this is energy transition. So I think it's both the region and the themes which appear very attractive to investors.
Matthias, we've had a long period, though, when it has been relatively easy to raise money. And you wonder whether that period is coming to a conclusion right now. Do the big get better as a result of that? If you are a big firm, if you are able to attract funds, does it become easier in this kind of environment with the kind of the infrastructure that the big funds have around them to generate money from LPs, whereas in the past, actually, everybody's found it relatively easy? Is that environment changing? And if so, what are the implications?
Not really. Maybe slightly better. But in fact, what we are seeing is that the market, especially the B2B, so the institutional market for fundraising, remains quite sluggish. So it's just the market share of certain players which are growing, which feeds their fundraising. So we see a strong concentration movement. And the reason for that is that basically in the current environment, it's very difficult to bet on financial market to create value. You really have to have specific expertise. You should be able also to raise in the private investor market, and this requires really strong capex, strong investments, and just the leaders can afford that. So that is really what is driving the market. First, the concentration of the market, so the biggers raise even more than before, and the mid-size or the mid of the cap or the smaller managers struggle probably to raise. That's the first factor. And the second factor, which on driver, is the private wealth, and this market is really the new frontier for all the large private equity players as Ardian.
Matthias, can you tie this fundraising, this deal activity? I heard, or at least it was reported, that 40% of this new fund has already been deployed. So you have 60% of the new cash raised looking for deals. Are you perhaps deterred by what's going on in France? We just heard from our reporter there that they are considering things like a wealth tax across the nation. Does that deter you from looking at French companies?
Well, as French citizen, I am obviously very frustrated by this instability, French instability. But I think we should not take too much this instability in the economy. And you see that basically the market has been sanctioning France after the presidential decision to dissolve the chamber. But in reality, the market has factored that, and we are just experiencing what was already anticipated by the market. France has strong institutions, and for example, we don't have such a shutdown, so in case there is no budget or there is difficulties to find budget in the coming months, what will happen is that we will take the existing budget and we will extend it until the next presidential election. You know that in France, what drives really the politics are the presidential elections, and that's what really will lead to again a stability and a new we say economic plan.
Matthias, it's also, you've raised this fund to invest in things like energy, transport, and digital infrastructure. Which of those buckets are you more excited about potential returns?
But the beauty of that is that those three buckets are very synergetic. There is no data centers if you don't have energy, if you don't have cheap energy, and if you don't have decarbonized energy. Connectivity, as I said, for me, infrastructure, and you know that private equity firms have very different definitions of infrastructure. Our definition is very consistent, is capital-intensive asset in what I call connectivity. Connectivity, real connectivity, like transport, airports, roads, but also virtual connectivity, obviously. But to basically to feed and to all this, you need energy. That's the enabler. So all this is very consistent. So there is synergies between them, but also they are counter-cyclicals, meaning that, for example, if you are exposed to data center, you are sensitive to the cost of energy. But if you produce energy, then you balance this reality. So all this means that portfolio construction is more than ever something which is very important. And that's also something I think that our clients have valued, not only the strong absolute performance, but also the consistency across the cycle, the ability to deliver performance across different cycles.
Matthias, good morning. It's Lizzy here. Are you worried about what's happening in private credit? We've had Jamie Dimon, the JP Morgan CEO, of course, warning that with Tricolor and First Brands, there's never just one cockroach, there's almost more to come. Are you worried that there are going to be more collapses in the pipeline?
I think we should have yes, we anticipate that the cost of credit, as the bank speaks, will increase. I mean, we have been experiencing a decade which with the capital and the debt was flowing massively at almost zero cost. We are entering now in a more, I would say, normalized environment, as if we look back to the history. And we will see that some companies, some borrowers who have bet excessively on capital markets and excessively on the ability to grow will experience difficulties. But I don't think we will have a massive, I would say, a systematic problem. It's more that we will see the cost of credit raising, and discipline and capacity to analyze risk and have a disciplined approach will make the difference between different managers and different banks as well.
OK, really appreciate your insights. Matthias Burghardt, Ardian's Head of Infrastructure and France CEO. Really good to have you on. Well, coming up on the programme, we've got another top interview. We're going to be speaking to BYD's Stella about the Chinese automaker's ambitious global expansion plans. And another thing to look out for, the Canadian Prime Minister Mark Carney appears as the first guest on the Michelle Hussain Show, our new Bloomberg podcast, which launches tomorrow. Don't miss that. This is Bloomberg.
Welcome back to the opening trade. Now, BYD's overseas sales have soared 130% in the first 9 months of the year, even as other Chinese car makers ramp up overseas production. With plants already in South America and in Europe, BYD is now growing its retail presence in South Africa, which is where Bloomberg's Jennifer Zabazaja is with one of the company's top executives. Jen?
Yeah, thanks, Val. I am standing by with Stella Lee, the Executive Vice President of BYD. And as you mentioned, of course, we know the company globally, but of course, the company is making quite a big push into the region and specifically South Africa. So let's get to her. Stella, it's great to meet you. Great to have you here in Johannesburg. Let's just start here because October, a very important month for BYD, as most months probably are, but you're trying to meet the sales target. We know that BYD recently revised down 2025 sales. Can you still maintain pricing power amid mounting competition that you're seeing domestically, but also internationally?
Yeah, BYD will continue to play a very strong position. Why? Because BYD is a technology company. So anytime you have a different solution, different competition, we always bring different strategy here. So we're going to play very strong in China. We're going to play super strong in overseas market.
Do you worry, though, about some of the competitors trying to take some of your market share?
No. You think about in the auto industry, nobody like BYD. We have 120,000 R&D engineers. Then we submit 45 patents per day. So BYD is not really just a car company. We are a technology company. Also, BYD not just have a car. We also have a battery storage. We have solar panel. We have everything. So BYD is a tech company.
Have regulations, though, made it a little bit difficult for you to maintain that strength?
Exactly, but it's fun. Because it always my first trip to here, then I suddenly found BYD can bring a lot of solution here. We can build up a solar panel flash charging station here. We put a solar panel on the top of a flash charger. Then we can power our electric car here.
Give us a sense of your long-term strategy across the continent.
So I think we will bring all the technology here, not just the car, but including the total solution. We're always talking about the 3 green dreams. I think here is the place we're going to realize, and then you're going to see the power of these 3 green dreams.
What would Africa and South Africa mean for the company? Get into some of the numbers if you can. What are the positioning that you're seeing long term?
Yeah, I think we are a little bit new to here, but this is a very important market because we feel this continent, especially also South Africa, need BYD technology to bring the solution, to bring also innovation here. Then they need a company like us to bring more valuable storage and solution here.
Do you plan to manufacture in South Africa?
We are in the initial stage for the double down and triple down our dealer networking and the building flash charging infrastructure here. So we don't have that plan yet.
What is your investment play, though, across the continent? How much are you willing to put in to make sure you're successful in this market?
Yeah, so one thing is BYD is a tech company, so we bring the electric car here. We also bring DMI super hybrid car here. This is all this technology is a game changer. So for example, our DMI, we call the DMI technology dual mode intelligent. Is a super hybrid. It means in the daily drive is rely on is a EV. So per charge you can get 50 or 200 kilometers.
Right.
And then once battery is empty, then it's become like a HEV. So but one charge, one tank of gasoline for our vehicle, we can run 1,500 kilometers, 2,000 kilometers. Nobody can do that.
How do you convince the markets that are used to internal combustion engines to buy into EVs, especially when you think about the price point?
This is the solution where I just mentioned, right? Then for BYD car, it's a more intelligent car. We don't need too much sales work, convincing work to customer. The only thing we need to bring customer to our dealer store and then let them do the test drive. Themselves will be convinced by BYD car. And also, when they drive use for a while, you will see the saving they have per month. Then this will make them convince them.
Do you think EVs could potentially be just as popular here as we see elsewhere?
If we don't invest on flash charger, then this will be challenged.
Right.
Because here we still is a big country here, and then still EV range and the infrastructure is are the two big concerns. So that's the reason the big news for us in here is we're going to officially announce to invest flash charging infrastructure here in South Africa.
How much?
We're going to put maybe 200 to 300 before end of next year.
How much are you willing to put in, though, for that?
This is big money because each flash charging costs a lot of money. So this is a big investment as our like step one.
Let's talk about other expansion plans. You haven't been in the U.S. at this point. Are you talking to the Trump administration at all, potentially, about moving there?
Well, we didn't have plan to into the U.S. market.
What about Europe? Let's talk about your play there. How do you mitigate some of the risks that the regulators are maybe putting on your company to expand?
I think we're doing very well in Europe, and also our facility in Hungary will start operation by end of this year. Then in Q1 next year, we will start to do ramp up to produce our car over there. So BYD already in the position turning ourselves to be local producer over there. So then BYD is doing very well, and then on dealer networking, on after sales service, and the people just enjoy our car.
There's some reports that potentially Spain could be the next hub in Europe. Can you give any validity to those reports?
I don't really follow that. My big more follow is really satisfy our consumer, our customers needs, and then for a lot of politics, a lot of topic is like for us is a short-term play, but the BY is a long-term player. We need to focus on where original market. If we produce in Europe, we hire 10,000, 20,000 local job. Then we'll become European manufacturer. We're part of this party. Yeah.
All right. We'll leave it there. Stella Li, Executive Vice President of BYD, joining us here in Johannesburg. Guys, back to you.
Jen, great stuff. Thank you very much indeed. Fascinating interview. Another fascinating interview. 2 days in a row. Amazing. Jennifer Zabajanja joining us out of South Africa. Let's talk about what is happening in France right now. I am watching what is happening out of the corner of my eye in the National Assembly in France. We've had quite some interesting to and fro between Le Pen this morning and Lecornu. We are expecting that ultimately we do see these no-confidence votes failing today and the government will continue. But for how long remains the open question here. And there's an awful lot of negatives that come with this in terms of pension reform and also windfall and wealth taxes. So it's not all great news this morning.
Yeah, if you delay the pension reform, it sounds like you're just delaying any progress on bringing in that wide deficit ratio that we know in France is the widest in the euro area at the moment.
Well, let's see when the bond market kicks in about that. But before we get there, you don't want to miss a key interview later on. We've got a conversation with the Fed's Christopher Waller. That's coming on Bloomberg Surveillance at 12:30 p.m. London time. He's also going to be sitting down with Tom Keane for an hour, no less. Good luck, Governor. That's it for the opening trade, though. The Pulse is coming up next. Stay with us. This is Bloomberg.